So how do you get to 100% financing using a HELOC? That's what we're going to go over today, how using a HELOC in investing makes it easier, cheaper, and more enjoyable. HELOCs are a must if you're in real estate investing. Why? Because it gives you flexibility. It makes things cheaper, and you could close a deal in a day if you want. That's why every investor that we talk to, we always encourage them to get one or multiple HELOCs on not only their owner-occupied, but even their investment properties. So if you're new to my channel, hi, I'm Mike Bonn, and for the last 23 years, I've been helping investors get funding correct. How do you maximize it? How do you make it easier and cheaper, just so you can be more profitable in real estate investing? One must for all investors that we work with is a HELOC, either a HELOC on their primary owner-occupied property or their rental properties or all their rental properties. And we're going to go through why that's important today and how you use it. We're also going to go through exactly what a HELOC is, what kind of HELOCs you want, and the ones you don't want. The first reason is you can fund any deal you want. If you have enough equity in your house, you could use that line of credit to buy a property, fund the whole rehab, everything. We just had a lady here in Oklahoma, one of our clients. She bought a property and the fix-up, all in was $49,000. That's an easy transaction just to fund by yourself instead of even going to a hard money lender, private lender, or a bank. You could fund it in a day. You could fund an auction property. We always have people calling us going, can we fund something at auction? It's the toughest thing to do, a sheriff's sale. But with a HELOC, you can fund that all by yourself or even just fund the down payment. So you're never gonna miss that really good deal if you have a HELOC that you can just go in to the bank, grab a wire, grab cash, grab a check, and go fund that deal and don't miss that deal. So with a HELOC, it allows some people with enough equity to fund their whole deal. The other big use for a HELOC is gap funding. So that's using your HELOC to fund the down payment, the earnest money. You know, if someone needs that money right away to lock up a property, or it's to get the repairs done. And that doesn't matter if it's all the repairs or part of the repairs, or even when you need reserves or when you need to carry the property, which means making the payments, making sure the insurance is up, or any overages you have. Using a HELOC is the cheapest way you could fund your gap in your loan. So if you find this helpful using HELOCs, hit the like button so we can help other real estate investors just like you. So the third way that people use HELOCs that we see is just to put more down on a property so they get better financing. It may mean that the bank requires another 10%, so they take the money out of the HELOC, put it down so they get bank financing instead of hard money or private lending. Or even with a private lender, if you put down another 10%, you get better rates, better terms, so overall your funds are going to cost less. So even if your HELOC is not large enough to fund the whole project, it's going to help you with your terms, with your rates, everything you could do when you put more money down on that particular project. Now that we see how people use it, either to fund the whole property, gap fund something, or put more money down, let's look at the positives and negatives of a HELOC, just so you know both sides. Positives are typically when you get a HELOC, there's little to no fees. Maybe you pay $100 to $200 to get a HELOC on your property. So fees are very limited when you're looking at a HELOC. Number two are the rates. You're going to see maybe some adjustable rates or fixed rates. Depends on what you get, but it's still cheaper than you're going to get in private money or hard money. It may be even the same that you're getting in bank financing. And you're not going to pay for any interest unless the money is out. Another positive is you can fund in a day. You're not going to wait, have applications in. You can fund it, you control it, you can get the money out today. Like I said before, it can be a wire from a bank. You can just go get a check, or in some cases, you could pay and keep track with a debit card that comes right off your line of credit. What are some of the negatives, or what keeps people from using lines of credit? The first thing is you have to own a property. So if you don't own a property or your property does not have equity, you're not going to be able to get a HELOC or a line of credit on your personal property or your rentals. Typically, when you're looking at lines of credit on an owner-occupied or the property you live in, most banks will go up to somewhere between 95 and some even 100% of the equity. If you have $20,000 in equity, you could still use a small HELOC, maybe for that gap funding or that carry cost. You're also going to need good credit to maximize your line of credit or even get a line of credit. And most banks require that you get approved through income, so your debt to income is part of this too. There's a lot of investors who like to write everything off so they don't have the income. So sometimes the HELOCs without the property, without the credit, is not an option. We're going to go through another option here in our next video if you don't have any of those things, so stay tuned for that. You know, the other things, the negatives that people run across is they use all their equity up, or they just don't treat it like a business, meaning when the project's done, they don't pay it off, and then pretty soon their house is over encumbered, has too many liens, owes too much. So make sure when you do a project, finish a project, you treat it like any other loan and pay it off. Now we looked at how you use it, the positives, the negatives, but what is a HELOC? And a HELOC is just like a large credit card that's attached to a house. You could use it, pay it off, and reuse those funds. It is a line of credit that you could use on many projects or any projects. How it's not a credit card is they don't have the crazy rates of credit cards. You know, you're usually anywhere between a third and a half the cost of a credit card on a HELOC. And you have more options, because unlike a credit card where they have a cash limit, on a HELOC you could take it all out in cash. You could wire all the funds. There is no extra fee compared to like a credit card. A HELOC is a line of credit similar to a credit card where you can go out, use it, pay it off, use it again, up to the credit limit that they've given you. So it is a mortgage. It is a loan on your properties. You could also get a HELOC on your primary or your rentals. And a lot of banks will allow up to 2 to 3 HELOCs on rentals. Now the biggest difference between the HELOC on owner-occupied and your rentals is the loan to value. Like I said before, on an owner-occupied or where you live, you could get a HELOC all the way up to 95 or 100% of your equity. Typically, when you're talking about a rental, they're going to cap it out at 65 to 70% of the equity in the property. So you have to have a lot of equity in a rental property to get a HELOC. Now, a HELOC comes in a period where you get to draw on them, and then they become a standard loan after that. So usually it's a 5 or 10 year draw period where you get to use it, like I said, like a credit card. After that, it becomes a loan where you have to pay it off over a term, just like a typical mortgage. But to combat that, you could always just refinance into a new HELOC, so you could always keep drawing on it. Even though if your current HELOC says it has a 5-year period and you're up to your 4.5 and you're thinking about, now I'm not gonna have that access, just refinance it because you probably have more equity and you're looking at a longer term just to keep using it. Remember, HELOCs are one of the best ways for you to cut the cost, put more money into your pockets. Let's look at an example how real estate investors use a HELOC. Let's say you have a HELOC, it's $100,000 on your property, and you find a property you want to put under contract. So you need $2,000 for earnest money. Instead of going to a lender or someone trying to figure out where it comes from, you just go to your bank, have them cut you either a cashier's check or give you a check on your account and go put it with the title. And now you have earnest money on your account. And how that looks for the HELOC now is you've taken $2,000 out of that $100,000, so you only have $98,000 available. You're only paying interest on the $2,000, not the other $98,000. So as you draw it out, you'll start paying interest, but the amount that's sitting there is still interest-free. Now, after you have the earnest money, now you have to put a down payment. So now you need $10,000. You may need to wire that to the title company. So you just either go to your bank, call your bank, and have them wire it out of your HELOC. Remember, you had a $100,000 HELOC, you've taken $2,000 out, so you have $98,000 left. Now you're going to closing. You need $10,000 to bring in for that closing. So you've already taken $2,000 out. Now you're going to have the credit union or the bank wire another $10,000 to title. So now you have $12,000 out. That $12,000 you're going to start paying interest on, but you still have $88,000 left. That's the 12 plus the 88 equals $100,000 you have in your HELOC. Now you're doing your project, you need repairs, you need to make payments, there's some taxes, whatever it is, you could go and draw out monthly, move it over to your checking account, just call your bank or just go online, move it from your HELOC over to your checking, or have a debit card. Some credit unions and banks allow debit cards on your HELOCs. So you could go to Home Depot, run everything through, have great accounting, and then at the end, let's just say you had the $2,000 for your earnest, $10,000 down, and then $30,000 you spent on mortgage payments, repairs, paying people. So you had $42,000 total. You're paying interest on the balances that are outstanding, not the whole amount of the $100,000. So when you sell the property or refinance your investment property, you take those funds, you put it back on your line of credit, your HELOC, and now you have $100,000 again to use on your next project. Or you could use it for 2 or 3 projects at the same time. That's the beauty of a HELOC. You are in control and you could use it whenever you want. Remember, it's going to help you either buy a property, fund that gap for the property, just like we talked about there, or drive down the expenses on your long-term or your short-term loans. Now, HELOCs are great tools, like we said, that every investor should have if you can have it, if you have the equity, you credit, and the income. Finding the best HELOC, because they come in different shapes and sizes, adjustables, fixed, 5-year periods, 10-year periods. If you want help with that, we have a great download. Just check out below. We also help a lot of our clients, make sure they get the best HELOC. So if you want our help with that, just reach out to us. Now, if you want to keep making money on real estate investing, just check us out in the next video.